Welcome back to the next episode of the Stock Market Options Trading Podcast, where I finish my discussion with David Sun. If you haven't listened to episode 20, the last episode, I highly recommend going back and listening to that one too. After listening to this one, no need to do that in order, but you definitely want to check that one out too. So much great insight in both episodes with him. Make sure you listen to the whole thing too, because you don't want to miss out on some of these topics, especially in this episode. David and I are going to get into what put spread or put selling really is. It's not really a bullish strategy as he puts it. We're going to be talking about managing risk of high probability trades, using stop loss orders, and where on the options chain we like to sell at. We'll also talk a little bit about bull and bear markets and if that's going to adjust the strategies that we do. So two things before we get started though. First, David and I are not financial advisors. Nothing on this podcast should be considered financial advice. Everything in this episode and on this entire podcast is for informational purposes only. We are simply sharing how we trade our personal accounts and our experience with that. And that's all we're really doing with this episode. Number two, if you're enjoying these discussions and if this podcast has helped you in any way, maybe understand something better or try something new, I would like to ask a small favor. Could you take 27 seconds and leave a 5-star review of this podcast on Apple Podcasts or whatever player you use to listen? Leaving a review would really help the show in the podcast algorithm world and would let me know that you're getting value out of the show and that I should keep doing it. I would really appreciate the support. So that's it. Now let's get into the rest of my discussion with David. Here we go.
I now trade primarily puts. I have a number of different income strategies that I run, and only one of them uses calls. The majority of them are put side only. And you hear these comments about, well, of course you're making money. It's a bull market, and puts only win in the bull market, and this and that. And yes, puts are by definition they win with the up move in the market, right? They lose when the market moves down. But what I want to say is, with the proper risk management, I don't see selling puts as a bullish strategy necessarily. Puts, naked puts or put spreads, they're just a vehicle for capturing time decay, right? I'm using them, I'm selling premium, and I have risk management. Of course, I'm going to take a loss when I need to or whatever, but it's just a vehicle. It's just a mechanic for trying to capture some of this data and some of this time decay. They can, yes, if the market goes straight up vertically and never comes down, of course, I'll be able to make more or capture more of that time decay, that premium. And if the market shoots down and crashes, in that moment in time, I'll probably take a loss and not capture any of it. But over time, because I'm always looking at the long-term expectancy, the put and the naked puts, it's just a vehicle. It's not necessarily expressing an opinion or a thesis on where the market's going to go.
Right.
So that's sort of the key mindset shift for me that I've made. I sell puts not because I'm bullish. I sell puts because I want to capture premium.
Right. And there's more premium on the put side.
For the same delta, yes,
yeah.
That's right. But I mean, yes, there's also more risk. I mean, there's so many moving parts.
Yeah.
So,
well, and it helps that the market is skewed bullish. So right. I still follow.
Oh yeah, it definitely helps.
The Fed. I mean, we wouldn't be, and I totally agree with everything you're saying. We wouldn't be saying that though if the market hadn't been skewed bullish, because the options would be priced differently and things would be different.
Yeah, that definitely helps. I do believe in positive drift and the long term. It just because you talk about bull and bear markets. Well, guess what? We've just been in one big bull market since the market started. Right? So,
it's funny because technically the COVID crash was a bear market. It was the fastest bear market because it was 20%
by definition, right?
By definition, yeah. You get into like what does that mean? But yeah. So this is a good question. So I put out a video on YouTube, or maybe someone commented, and I find most of the research videos that I put out, either at my membership or YouTube, end up being put spread selling type strategies, basically bullish. And the one question I get is, does it work in reverse? So I do things with moving averages, like, if these moving averages are looking bullish, then you sell puts and yada, yada. And the answer is always no, it doesn't. It does not work in reverse. When the moving averages cross down or whatever, you cannot sell call spreads because the markets go down faster than they go up.
Okay.
And if you're selling premium to the upside, you need the downside to be prolonged so that you can capture the theta. But theta
Right.
does
Right.
not, theta, in theory, you get equivalent theta decay over time, and then it ramps up close to expiration. But the market doesn't stay down long enough
Got it.
to really capture that premium. However, on the bull side, which would, and we, the upside, if you will, the market stays afloat enough for you to capture that premium. And I think we both, and it's funny because I think we're both ending up in the same place. And I want to talk about where on the chain here in a minute, but we're both ended up in the same place through different experience, because what I'm hearing you say is that you're doing more put selling than you are call, right?
That's right.
And
yes.
you've chosen, in a sense, to manage the risk on the put side versus being more delta neutral, like carrying the, I don't want to say carry the hedge, but is that true? Or
Well, I do carry a hedge, but that's
okay.
different because that's like a tail risk for my overall portfolio. And it almost becomes more of a downside lotto because I've decided just to budget a certain amount of capital to paying for a hedge. And just like you pay for car insurance or home insurance, I'm just paying for insurance, and I don't mind. And I don't have, and this isn't some kind of convoluted trade where I'm trying to finance it or try to take profits and try to make, I fully expect to lose on this. It's just there for peace of mind. So again, it's a mindset thing. So I have that, and that by definition is a negative delta position, positive vega. But again, that's
gosh,
that's
I want to do a whole,
right?
I'm going to have you back because I want to do a whole nother episode on just that, because I've have found a couple things that help me with that. I do the same thing, and what that would mean versus selling naked versus selling a wider spread, because ultimately when you spread it off, you're essentially hedging your downside, reducing your capital. I don't want to get caught up on that because that's a whole other deep topic. But I would love, for you to come back, and I plan on having you back. Are you going to come back more? Because I know we only have so much time today, but we do have more time. But I want to get I want to talk a little bit about, and this kind of bridges the gap from Tasty Trade a little bit. I find myself selling closer to the money these days from my own personal research and how I manage my risk. I've found it easier. There's more meat on the bone, if you will. And I kind of look at it like this, like you have a leg, right? A human leg. This is probably the most ridiculous analogy, but delta 50 is the top of the femur, right? The top of the thigh, right? The farther you go down the leg, and I'm gonna say that the knee is delta 30. And we've talked about this before. To me, there's some kind of something with delta 30 that I haven't figured out. There's a magical mystery there. The delta 30 tends to be a very good spot for certain things, but then a lot of people go farther down the leg where there's less meat, and they're selling delta 20, delta 10, and you got the ankle biters at delta 5 and 10.
I'm an ankle biter.
Are you an ankle biter?
Yeah, I'm an ankle biter.
I hope that's not offensive to any degree, but you know what I'm saying? It's a higher probability, but and more, there's a consistency there, but the risk is greater. So that's what I wanted to get to. So you're hanging out more at the are you basing this off standard deviation, or why do you hang out?
Not even that. I'll get into kind of how my systems work, but
can you give me a delta? What delta do you what delta are you hanging out at?
One system I trade is between 10 and 20. Another system I trade is 5 and below.
Okay.
So I have different regimes depending on the different time duration and everything. But about that, there is a lot of moving parts in terms of the interrelationship between the Greeks, the vega, the theta, the delta, the gamma, and why, like you said, why certain things work better with different kind of mechanics, right? 50 delta, you get that maximum extrinsic, that shot of pure premium when you go in. 30 delta has this kind of trade-off between the probability and the premium, and there's a reason why Tasty Trade, for example, gravitates towards that, but it requires a different kind of mechanic. The reason why I hang out lower is because I've chosen to do extremely simple systems, extremely low maintenance. I use what everyone loves to hate on. I use hard stops. I cut off my trades automatically at a certain stop level. But here's the thing. Your expectancy, which is your kind of net profit or how much premium you can capture, it's based on three things. Your win rate, of course, which people love to focus on,
Mm-hmm.
the amount of your winners, which people love to focus on,
Yep.
and the amount of your losers, which
Yep.
people just never focus on, right? So a lot of the big mistake I see a lot of people making is they focus on the win rate and the winners. They don't focus on the losers, and that's going to drop your expectancy.
Yep.
But what I do, for example, is I fix the win and loss size, and only the win rate will determine my expectancy. So one system I do, example, I do a 2x stop loss. If I sell it for $1, I close it if the premium hits $3 for a net loss of $2. So it's risk two to make one. So of those three variables, I have fixed two of them, the win size and the loss size. Now, not accounting for slippage and commissions and fees, if you have a risk two to make one, your break-even win rate is exactly 66.666, whatever it is. You just have to win 2 out of 3 trades to break even. Okay.
Right.
That means if you win more than that, you'll make money, right?
Right.
I don't care how much, it's going to be positive.
Right.
And through my back testing and through just empirical studies in my trading, so one system I just do a 7 DTE put. It's always at the same delta range, okay? And I put the stop loss on. At 30 delta, I found that the win rate was high enough, but then it basically broke even after slippage because my net loss ended up being 2.3, 2.4x because when you do a stop, you don't always get a clean fill. So I kept lowering the delta until the win rate was high enough, because the thing is, people say like, okay, 30 delta is 70% pop or 20 delta is 80% pop, but that's only at expiration. And again, the pop does not translate to expectancy. You can have an 80% win rate, but you'll still lose if the losses are too big. So I know, and people hate using stops because they say stops lower your win rate. Well, again, I'm fine with that. They do.
Exactly.
Right? But if it lowers my win rate, but yet my win rate is still above that magic number that I've designated by virtue of setting my win and loss ratio, I will make money. So I just lowered the delta enough until my realized win rate, even with the stop, was above that magic number. Now, with a risk two to make one, if you have about a 75% win rate, you'll basically capture, and make sure I'm doing the math right. And also, I don't take a profit target. I've run it to expiration, so I'm capturing 100% on a full winner. So with risk two to make one, yeah, I think you basically capture about 25% of the premium. So if I have a 75% win rate, risk two to make one, for every dollar of premium I sell, I will capture 25 cents. So I know I don't know, but I have an expectation. If I sell $1,000 of premium every week, I'm going to make about $250 net after factoring losses a week. And all of my systems are just kind of based on this expectancy. And that's why I've chosen to do it this way. So I kind of fell into it based on the way I wanted to set up my system and the way I wanted to trade and the amount of time I didn't want to spend having to watch the screen, having to adjust, having to do whatever. I put a trade on, I set a stop, I walk away, I'm done, right? And my order page is full of just stop orders.
Yeah. Oh my God. So there's so many things I want to unpack there with you. Let me start with because I'm doing the exact same thing, just at a different part of the scale. It's almost the exact you're doing the exact same thing I'm doing, except my math is different, right?
Sure.
And so one fear, I guess, that I have, and it partially this has to do with and we've talked about this, my inability to backtest intraday stops, right? So if you're selling DTE, my fear is that, yes, if I put a 200% stop on the max gain, that if I experience a gap down the next day, that the premium's going to temporarily spike.
Right.
I'm going to get stopped out, but I'll never. But the volatility might be enough to stop me out, as opposed to actual price, and therefore I don't do that because I don't have the ability to backtest that to really know. And that leads me to the next thing where you said, and you corrected yourself, but I think it's telling, because I'm the same way, where you started to say, well, I know that if this happens, and you said, well, I don't know, but I expect. that what that is, and that's what everybody needs, is they need the confidence, right?
Conviction.
You need the conviction. So you have the conviction enough to use the words that I know,
Right.
right? As opposed to, well, it should, right? Should's a bad word. But technically it should, right? Over time, it's
right.
over time, but the trade you're putting on right now, you have no idea, right? There's a macro,
right.
There's a macro conviction, and then there's micro execution, which sounds like what you're doing.
Right.
And the other aspect that I think is important is I call it the crock pot, right? You're going to set it and forget it,
yes,
right?
Absolutely.
Everything you've done for your trading, and we're just going to stick with that 7 DTE put selling. All decisions are made upon entry, and then you're done.
Yes.
And so what you're doing is you're avoiding any headlines that pop up on your phone, any I don't know if you're on Twitter. Twitter's the worst, but I'm on there. I'm avoiding, there's a lot of information we get, and sometimes it affects, the election and the, all the things, the Capitol riots and all these things. And because I'm trading the index, I'm in tune with the Fed and and geopolitical Washington stuff.
I am too, but it doesn't change anything. I'm not gonna go change my order, right? I still, and that's maybe I shouldn't, because all it does is cause me undue stress sometimes. I know, I'm
and most of the time it's not helpful, right?
right.
Yeah. But I totally am buying into what you're saying about having the conviction through back testing. I know we've talked about back testing, and I'm going to do another episode about getting intraday back testing. Maybe we're going to maybe try to work together and share info and data, because it seems like end of day back testing is only is more easily available, although it's not cheap. But yeah, no, I think that's interesting that and I'm trying to get to that too, where I'm trying not to make any decisions after I'm on the trade, and I'm only forward looking. And but yeah, if you can set your stops and all that stuff. So do you see that now I'm just curious, do you see that sometimes where if you're, Tasty Trade actually wants you to avoid the short-term part. They want you out of the trade before 2 or 3 weeks before expiration, because there's more gamma risk, right? Like if that volatility spikes on a, jobs report or whatever it is, is that stop loss usually big enough to absorb a little bit of that, or do you find any kind of like big gap downs that you get stopped out that same day, or how does that work?
So there's a trade-off, and I have systems in different parts of, you talk about the delta curve, I'm in different parts of the time curve as well, 45-day, 7-day to the 3-day. Naturally, as you get closer to expiration, the vega, the extrinsic risk goes down, right? You're taking on the gamma risk, of course, so it depends on, so when you're close to expiration, the spikes in volatility don't hit you as much. But if there's an actual gap, and one thing I need to say, because people are like, well, how do you always get out at 2x? I don't. There are gap losses. I've been gapped out at 4x, at 5x. And it happens, but again, I budget for it, because I told you that magical win rate of 66% is break even, but that doesn't account for gaps. So yes, empirically, I need to have a 80%, maybe 85% to have that kind of healthy expectancy. But that was why I backed into this delta range. I kept backing out until I found that sweet spot where even with the gaps, even with this and that, it was still running at the expectancy that I was hoping for.
Right. Okay. Personal question. So let's say the math, it's more theoretical. You know the math where you said, you need to have a 66% win rate to break even, and you're running, let's say you're running a 75%, so you're good with that.
Right.
Do you think the win, like, do you need the win rate for your own personal what do you call it, just satisfaction?
Yes.
Right. So for example,
the answer is yes.
Okay. So yeah, right. So I'm the same way, like, because I know, like, I read these books, Market Wizards and all these things, and they talk about how some of these, and then this really doesn't maybe apply to what, some of the stuff we do, but the idea that and this is my hedging strategy, and yours is probably the same, is the win rate is close in the 30%. right? Like my
Or
win
even
rate,
lower, because mine's a tail risk, so I'm never gonna take it
right?
off
Yeah,
except once a
my
decade, right? So it
right,
might be like
right.
1%, right? Fraction of a percent.
But I know that over time that I'll lose, it's I think when I did a recent 5 year study, I updated every few years or every year. And the win rate for me buying invert volatility ETFs like
Sure.
VXX and those things,
Right.
you're in the 30%, right? However, every now and then you get the one that's the winner that's so big
Yeah. Yeah.
that's when
10,000% or whatever.
yeah, you get, you get this winner that's so big. And if you're carrying a lot of positive delta via puts, I do a lot of spreads, but
Right.
um, that can offset that. And then, but over like, let's say 6 months, this just may be a losing trade for
Right.
me. And so we're okay with a losing strategy as a hedge, but from our bread and butter, we want it to be winning,
Yes.
right? Right? Yeah.
Yes. 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 Because
Yeah. That makes sense.
uh, uh, because I have different strategies along the delta curve and the time curve. I have one strategy that I really need about a 90% win rate to be profitable, and then one that's like 80 and 70 and so forth. And I
Mhm.
have one strategy that's actually a reverse risk reward ratio. The reward is higher than the risk. It's approximately risk one and make two, but that actually makes the winning win rate lower. You can have a 33% win rate.
Mhm.
And again, after slippage and everything, this is actually what I call kind of a low win rate strategy. And there's no way to really know the true win rate because again, I'm using a stop, but we figure it's going to be in the 50 to 55 range. And it's actually one of my better strategies, but I hate it because when you talk about 50% win rate, you're basically losing every other trade.
Right.
And I I have this thing where I graph my net P&L aggregated with my individual trade P&Ls. And you can see the aggregate one is a nice, steady, slow climb, but the individual one is like one up, one down, one up, one down. And like,
Right.
yes, when you back out and look at a year, oh, I made a bunch of money or whatever. But in the day,
Mhm.
every single time I'm like, oh my God, it's another loss. It feels like you're losing all the time. And
Yeah.
that's psychologically, that makes it really challenging. But that is in fact one of my better strategies from like a consistency and net P&L. That's the interesting aspect. Even though I know, and the thing is like I don't know long term. Like I know the math is good, but I don't know is that next trade going to be a winner, or am I even going to have like
Right.
10 losers in a row because the win rate is actually very very low. So psychologically, it's challenging, and like I'm like every
Yeah.
day it hurts. No,
Yeah. 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 And it's hard because especially if you're doing short term, like if you've had three losers in a row, you still got to put the next one on,
yes, yes,
because
right,
if you don't, you're breaking it. And then
right, exactly,
if you I'm trying to I'm trying to get better this year about understanding all my strategies as they work together. Because for what you're saying, like overall, you want your account to go up, but the individual things in between may be, you know, some you might have losers and winners, but ultimately you're not having a big drawdown. Um,
right,
so we're coming up on the hour. I want to ask you one more question, and then we're
sure,
going to have to set this up again and do another
yeah,
episode.
yeah,
But I wanted to ask, back to kind of big market thesis. I get a lot of questions from people want to know, well, did these strategies work in the '08 crisis? So I know we're doing very similar things. We're selling a lot of premium underneath the market. And are you primarily trading SPY, SPX, or mostly index stuff, or
at the moment I'm exclusively trading SPY and SPX.
yeah, that's where I end up too. I do some stock buying in my different system, but from options wise, it's mainly SPX.
Right.
So one of the things that I have tried to factor in is and it doesn't help actually in at least the last 5-10 years is only trading when the market's above like some sort of bull market filter, if you will.
Right.
And the basic one is like the 200-day moving average. But my concern for for what we're doing is the next bear market that's actually prolonged in any sense. I feel like we're going to have to come up with something else because you might get the hedge risk that saves you from the big crash. But like, for example, like COVID had COVID crash, and maybe it took another leg lower and just stayed down there. I mean, once it stops moving and you're selling under, it's fine. But do you have any thoughts about that? Like what are you going to do, or do you think it's going to be different if you end up with more of a prolonged bear market as opposed to these buy the dip things we've been in?
So obviously, I don't know if it will be different.
Right.
But again, because of the way my systems are designed with hard stops, I'll be out of there before, sure, I'll take maybe 3 or 4 losses on the way down, get stopped out, stopped out. But at some point, it's either going to turn around or stop or slow down, and the probability start working. Because if we keep going down, volatility goes up, I can get even lower delta, even further from the money.
True.
So there's a reflexive nature to that, because I do believe everything is priced and everything's priced perfectly. Now, if you're using a system like mine, I think that's the benefit. It's almost like a self-regulating in that sense, because when I get stopped out and I put on another trade, that's actually kind of like a roll, right? Guess what a roll is? Closing one out and putting another one. So you can almost say like my system is just naturally adjusting my delta. The thing is, again, if you're doing kind of a tasty trade style where you're holding on to positions and going to inventory that large loser, that's okay too, as long as that individual position is small enough that you're taking this big, multiplier, 5x, 6x, whatever it is on that position, but it's not a large proportion of portfolio. And that comes out again just to be if you're well capitalized and you have a lot of dry powder, you're keeping the BPR low when volatility is low, so that when there's that big move, you can kind of throw more powder at it and take advantage of it. But that's completely different. You have to have really good bankroll management and a big bankroll to begin with. So depending on your trading style and your approach, that's gonna translate to a different management and outcome for those kind of events. But I believe the way I've built my systems, it sort of takes care of itself, because the risk management is very tight with me. So if we had this prolong, I'm out of there. So I don't see like a huge drawdown, even if there's like a huge down move per se.
Right. Good point. Good answer. I hate to cut it off. We've come up to our hour. I definitely want to have you back on the show. So we're gonna set something up. Where can people get in touch with you if they want to ask you questions? What's the best way for people to contact you?
Yeah, so I set up what I call my quote unquote trading page, but it's really just a Google Sheets where I have some essays I wrote, links to various strategies, and even like a little back test demo I built. The link is thetradebusters.com. So just think of the Ghostbusters, but it's thetradebusters.com.
Gotcha. Okay.
I do plan to make an actual page sometime this year and move everything over, but just don't be taken aback if you go and it's like this janky, like Excel looking thing, but that's what it is. So
it's pure. I've been there. It's pure information. I definitely think everyone should go check that out. Definitely read the essays. You've got a few essays there, which I think are very
my email address. My email address is there as well. So
okay. Yeah, and I'll link that up in the description and stuff. And when I send this out, I'll include that. But David, this was awesome. I'm hoping you'll come back on the show. I hope you enjoyed it. And we'll talk to you soon. Okay.
All right. Thanks so much.